Hi, I'm Josh Kettleson.
And I'm Christo Schultz. So Josh, a common question I get is, when's the next recession going to hit? Now, I don't know that. I don't think you know that. The more important question is, what do we do when the next recession does eventually hit?
Yeah, it's a great question. And the fact of the matter is, we're going to experience recession, or what is considered a considerable decline in our economy, or 2 quarters of negative domestic growth. That is a recession. A couple of things to think about a recession. They're going to happen. It's an aspect of the kind of economy that we live in. Things go up in value and then they go down in value. Things become profitable, become unprofitable. It's just a natural cycle in the type of world we live in. A couple of things to think about it. First of all, most recessions last less than 9 months. So before we even know we're in a recession, we're more than halfway through it already. All right? Same thing to remember is, despite what people on TV or the newspaper or the radio proclaim, XYZ predicted the next recession, that means it's worthless, because we don't have ability to predict the future at all. There might be some indicators and things like that, and there might be times to say, hey, maybe the time's coming, but no one can accurately predict the next, because then there would be no recessions. Right. If they'd have that, it would be a computer model. And
these guys that hawk gold on TV have been predicting a recession every year for the past 15.
For 15, at least 15 years, since I don't trust the American economy. Well, the most losing bet in world history is betting against the United States economy, because it's never been very fruitful. But the fact of the matter is, we are going to see a recession or negative growth in our economy probably once every 5 years. I think we're going to see major corrections. When I mean corrections, you're going to see your stock market pull back 15 or 20%. We're going to see that every 3 years.
Right.
We're going to see 10% declines in the stock market. I can almost guarantee once a year.
Right.
And we do constantly.
And that's what the data shows, is that once a year you're going to see at least a 5%, if not a 10% correction.
Sure.
Once every 12 or 9 months.
Yeah.
So that's just a part of investing, and we just got to get through
It's
that.
a part of investing, Christo, and it's even more importantly, it's an opportunity. Because I see so many people who are newer to investing, who might not be as sophisticated or have the experience of living through one of these. You and I have lived through many of them, so they don't know what to do. And the knee-jerk reaction is, oh no, the stock market just went down 30%. Let me stop saving.
Right.
Let me stop investing in my 401k plan because it went down 30%.
Right.
What other aspect to shopping or consumerism do you think it's a better deal to pay a higher price than a lower price? And it's the same way with quality investments.
Right.
They're going to go down in value. And when they do, that's when you want to keep up your 401k contributions.
Yep.
That's when you want to look at, is my nest egg significant enough where I can take some of my excess cash and deploy it?
Right.
Because believe it or not, COVID was a tough year, or 2020 was a tough year because of COVID. People lost their jobs. And I don't want to belittle the suffering.
Right.
But folks who had extra cash on hand had one of the biggest buying opportunities in the last 20 years occur between March and but June of 2020.
Right.
Tremendous opportunities buying high quality companies that were profitable, no less. And they've seen, it's one of the biggest things we're running into now is people are getting 50 or 80% returns in 8 months, thinking that's going to be the new normal.
That's the norm.
No, it's not going to be the new normal. But we've seen the same thing in the recession before, the major recession in 2008, 2009. But we see these incremental changes. But clients, and only as clients, people, we tend to remember the last 2 tragedies. We remember COVID's stock market crash. We might remember a big decline we had just the year before that.
Yep.
But we forget about all the other ones, going back to, I don't know, the Dutch tulip problem, going back hundreds and hundreds of years.
Right.
But more recently, the Great Depression. So people remember, when I got in this industry, I had much older clients that remember the effects of the Great Depression that were still living. So we tend to forget that not only are these going to happen, they're guaranteed to happen. That's why there's money being made in the stock market, but that we weather them beautifully if you're properly diversified.
Right. One example that I like to use, Josh, is I say that if your house was declining in value or the market for houses was going down, you wouldn't sell it.
No.
Now, that's not saying you wouldn't go out and buy more houses. Maybe you would, but you certainly wouldn't sell it. And that's the thing that you don't want to do with the stock market, is if it's going down, again, like your house, not the optimal time to sell.
Sure. And if you're properly diversified, there's 2 factors that are going to happen. You're going to have the best performing asset class at any given time, and you're going to have the worst performing asset class at any time.
Yeah.
That's proper diversification. That's saying I'm going to have everything. I'm going to have eggs spread out, and so guaranteed, even in a great portfolio like the ones we try to build for our clients, one or two of the asset classes aren't going to do as well in a given time than the others.
Right.
And that's by design. It's to give you that safety net in case things do go bad in one sector that they might not in the other, and vice versa.
Mm-hmm.